Picture this. It is early April. You are sitting at your desk, coffee going cold next to you, staring at your screen. You just finished entering everything into your tax software. The salary, the bonus, maybe a little freelance work you picked up on the side. You did everything right this year. You worked harder, you made more, you finally got that raise you had been waiting on for 2 years. And then the software shows you what you owe, and somehow it is more than last year. You sit there for a second, just trying to make sense of it. You did not cheat, you did not hide anything, you didn't even try to be clever. You just worked, earned, and reported every dollar honestly. And the reward for that honesty is watching a significant piece of your year disappear before you can do anything with it. There's this specific feeling that comes with that moment. It's not quite anger, it's more like betrayal. Like you showed up to a game, played by every rule you were given, and still somehow ended up on the losing side. You have probably been told your whole life that taxes are just the price of living in a functioning society. And maybe that's true. But here's what nobody tells you. Not everyone is paying the same price. Some people are paying a fraction of what you pay. And the gap has absolutely nothing to do with fraud, offshore accounts, or expensive lawyers finding secret loopholes. The tax code does not treat all income equally. The wealthy figured that out a long time ago, and the sooner you understand what they actually know, the sooner you stop being confused by your own tax bill. Now, the natural instinct when you hear that billionaires pay lower tax rates than teachers is to assume someone is cheating. That framing is actually comforting in a strange way, because if the system is being abused, that means the system itself is fine. It just needs better enforcement, better audits. Close the loopholes and everything becomes fair again. But that's not what's happening. The uncomfortable reality is that there are no secret loopholes here. There's just a tax code that was built with two completely separate systems running inside it at the same time. One system governs people who work for money. The other governs people whose money works for them. And those two systems operate under entirely different rules, different rates, and different timelines. By the time this video is over, you are going to understand exactly which system you are currently living inside, why it is costing you far more than your annual tax bill, and what it actually looks like to move from one side to the other, not theoretically, structurally. Most people think about taxes the way they were taught to think about them in school. You earn money, the government takes a percentage, you try to find some deductions, you file, you pay, you move on, and try not to think about it until next April. And within that framework, people try to optimize. They max out their retirement account, they keep their receipts, they maybe hire an accountant to find a few $100s more in deductions. They are playing the game as hard as they can. The problem is they're optimizing inside a system that was never designed to reward them. Here's the thing that changes everything once you actually see it. Earned income, your salary, your bonus, your freelance invoice, your overtime, is the single most heavily taxed category of money in existence. Federal income tax hits it, state income tax hits it, payroll taxes hit it. It gets taxed from multiple directions before a single dollar reaches your bank account. You don't even see the full amount you earned. It's already gone before it's yours. Now, contrast that with what happens when an asset grows in value. If you own stock and it doubles, you owe nothing. Not yet. The government doesn't get involved until you decide to sell. And if you're wealthy enough to live without selling, then the government is just sitting there waiting for a tax event that never has to arrive. Think about what that actually means. When you work, the government collects immediately. When your money works, the government waits. And while it waits, your wealth keeps growing. The worker is taxed on the way in. The asset owner controls whether the taxable moment ever comes at all. One person is on a treadmill, the other is on an escalator, And the escalator doesn't announce itself, it just quietly takes certain people to a different floor. Here's where it gets hard to sit with. In multiple recent years, some of the wealthiest individuals in this country paid effective federal tax rates in the low single digits. We're talking rates that a school teacher, a nurse, or a mid-level manager would look at and not believe. And it wasn't because of fraud, not because of offshore schemes. It was because the income they reported looked completely different from the income you report. You report wages. They report almost nothing, because the way their wealth moves doesn't register as income under the tax code. You are not losing to someone who is cheating the system. You're losing to people who understood that the system has two different doors, and they walked through the other one. The concept sitting at the center of all of this is the difference between a realized and an unrealized gain. That one distinction is worth more to wealthy investors than any deduction, any accountant, and any tax strategy most people have ever heard discussed, and almost nobody explains it in plain language. So let's do that right now. There are 3 structural advantages baked into the tax code that quietly benefit asset owners and quietly punish wage earners. Understanding all 3 is how you start seeing the full picture. The first one is what you could call the waiting game. When an asset increases in value, no tax is owed until the moment of sale. That growth, sitting inside a stock portfolio or a piece of real estate, is called an unrealized gain, and unrealized gains are completely invisible to the IRS. Say you bought shares of a company for $10,000. Today, those shares are worth $90,000. You have gained $80,000, and you owe exactly zero on that $80,000. It sits there, compounding, growing, working, completely untouched. Now, here is the key insight that most people miss. The wealthy do not just invest with the intention of growing their money, they invest with the intention of never selling. The strategy is not to cash out at the top, the strategy is permanence. Keep the asset, let it grow, never trigger the event. Which immediately raises the obvious question: if all their money is locked inside assets they refuse to sell, how do they actually fund their life? That is the second structural advantage, and this is the one that genuinely rewires how you think about debt. Instead of selling assets to generate cash, the wealthy borrow against them. They go to a bank, use their investment portfolio or real estate holdings as collateral, and take out a loan. The bank is happy to lend because the assets backing the loan are substantial, and the interest rates on these kinds of loans tend to be relatively low. Here's the part that matters. Loan proceeds are not income. When that cash hits the account, the IRS sees nothing. There is no taxable event. There is no reportable income. It's just borrowed money, and borrowed money does not appear on a tax return. So they're funding their lifestyle with tax-free cash. Their assets remain untouched and continue compounding, and on paper, they look like they have almost no income at all. And the math makes this even more striking. If someone borrows at a 3 or 4% interest rate, but their portfolio is growing at 8 or 10% annually, they're actually making money on the borrowed funds. The loan pays for itself through portfolio growth. They're living their life on the bank's money while their own wealth compounds uninterrupted. Compare that to your situation. You earn income. 30 to 40% disappears immediately. You invest what's left, you're starting the compounding race already down by a third. They never take that hit. Every dollar stays in the game. The third advantage is what happens at the end of a life, and this one is the most significant of all. When a wealthy person passes away and leaves assets to their heirs, something happens inside the tax code called a step-up in basis. The cost basis of those inherited assets resets to the current market value at the time of inheritance. What that means in practice is this. Say someone spent decades accumulating a stock portfolio. They bought those positions at very low prices. By the time they pass away, the portfolio has grown enormously. Under normal circumstances, selling any of those positions would trigger a massive capital gains tax on all of that growth. But the heirs inherit the assets as if they purchased them at today's price. All of that accumulated gain, decades worth, is simply erased from a tax perspective. The heirs can sell those assets immediately and owe nothing. So the loan that funded the lifestyle, the heirs sell a portion of the inherited assets, pay off the debt, and keep the rest. No capital gains tax because the basis was reset. The debt disappears, the wealth stays in the family, and the cycle begins again. Buy assets, borrow against them to live, die, and pass them on tax-free. This is not an accident. This is not a glitch. It's a feature. It was built this way. Here's the thing that actually matters most about everything you just heard. There are two kinds of participants in the tax system: earners and owners. Earners have their taxes decided for them before they see a dollar. Owners decide when and whether a taxable event ever happens at all. Most people spend their entire financial lives trying to become better earners: bigger salary, higher title, better bonus. And the tax code quietly penalizes every step of that climb. The higher your earned income, the higher your rate. But this is not a video telling you to earn less. It's a video telling you that earning can't be the whole strategy, because if earned income is the only thing you're building, you're playing one game while an entirely different game runs alongside it with completely different rules. The shift is not complicated to describe. Stop measuring your financial progress only by what you earn. Start measuring it by what you own. Stop trying to optimize your tax return after the fact. Start thinking about how you structure when taxable events occur in the first place. Stop seeing debt as inherently dangerous. Start understanding the difference between debt that drains and debt that builds. You don't have to stop earning. You have to stop thinking of earning as the destination. Now, none of this works overnight. You can't borrow against a portfolio you haven't built yet. You can't inherit a stepped-up basis on assets that don't exist. The math only works once the foundation is there. But here's what most people get backwards. The wealthy don't have access to these strategies because they became wealthy. They built wealth in part because they understood these strategies and organized their financial decisions around them long before the numbers were large. The first move is not about the money, it's about the framework. Start running every financial decision through a single filter. Does this make me more of an owner or more of a consumer? Every index fund contribution is a step toward ownership. Every dollar not spent on something that immediately loses value is a dollar that could be working. Every small asset you acquire is a brick in a foundation that eventually supports something much larger. There's a crossover point. It's different for everyone, but it exists for everyone. It's the moment your assets can support your lifestyle. The moment the tax event never has to come. The moment the system that was designed to extract from wage earners starts running in your favor instead. The tax code is not a burden placed equally on everyone. It's a set of incentives pointing in a very specific direction. The only question is whether you're finally going to start following them. If you want to understand the actual mechanics of building asset-based wealth, not the concept, the real structure, that's exactly what this channel is here for. The next video picks up right where this one ends.